Hello, fellow investors. Have you ever looked at a stock chart and felt overwhelmed by the zigzagging lines? Don't worry, you're not alone. Those lines tell a story written in the language of candlesticks. Each candlestick is like a piece of a puzzle, revealing the sentiment of buyers and sellers in a particular time frame. Imagine you're at a bustling marketplace. You see vendors selling their wares, some attracting large crowds, others struggling to find buyers. Candlestick patterns are similar. They give us a glimpse into the market's mood, helping us identify potential buying and selling opportunities. Understanding these patterns is like having a secret code to decipher the market's whispers. It's a skill that takes time and practice to master, but the rewards can be substantial. Let's embark on this exciting journey of understanding candlestick patterns together. Before we dive into the fascinating world of candlestick patterns, let's understand the basic structure of a candlestick. Each candlestick represents the price movement of a stock over a specific period. Think of a candlestick as a visual representation of a day's trading activity. The top of the candlestick, called the high, shows the highest price the stock reached during that period. The bottom, called the low, represents the lowest price. Now the interesting part. The thick body of the candlestick represents the opening and closing prices. If the body is filled or green, it means the stock closed higher than it opened, indicating buying pressure. Conversely, if the body is empty or red, it signifies the stock closed lower than it opened, suggesting selling pressure. Understanding these simple elements of a candlestick is crucial for interpreting candlestick patterns. It's like learning the alphabet before you can read a book. Now that we're familiar with the basics, let's explore some bullish candlestick patterns that signal potential upward price movements. These patterns are essential tools for traders and investors, providing insights into market sentiment and potential future price action. These patterns are like green lights for traders, suggesting a higher probability of the stock price going up. Recognizing these signals can help traders make informed decisions, potentially leading to profitable trades. The first pattern we'll discuss is the hammer. This pattern is particularly significant in technical analysis because it often appears at the bottom of a downtrend, indicating a potential reversal. Imagine a hammer hitting a nail. That's the kind of strong support this pattern indicates. When you see a hammer, it suggests that the market has found a strong support level and the price is likely to bounce back. A hammer has a small body at the top and a long lower shadow, resembling a hammer. The small body indicates that the opening and closing prices are close to each other, while the long lower shadow shows that the price dropped significantly during the session but recovered by the end. It suggests that although sellers tried to push the price down, buyers emerged with force, driving the price back up. This buying pressure is a strong indicator that the market sentiment is shifting from bearish to bullish. Another bullish signal is the bullish engulfing pattern. This pattern is a powerful reversal signal that often appears after a downtrend, indicating a potential shift in market sentiment. Picture a large green candle completely engulfing a smaller red candle. The green candle represents a strong buying day, while the red candle represents a selling day. When the green candle engulfs the red one, it shows that buyers have taken control. This pattern indicates a strong shift in momentum from sellers to buyers. The larger the green candle, the stronger the signal, suggesting that the buyers are overwhelming the sellers and pushing the price higher. It's like a wave of optimism washing over the market, pushing the price upwards. Traders often look for this pattern as a confirmation of a bullish trend, as it signifies a strong change in market sentiment. For instance, look at the chart of Reliance Industries from March 2023. This real-world example helps illustrate how these patterns can be applied in actual trading scenarios. Notice the hammer pattern formed near the support level, followed by a bullish engulfing pattern. These patterns together provide a strong indication that the price is likely to move higher. These patterns signaled a potential trend reversal, and indeed, the stock price surged upwards. Recognizing and understanding these patterns can be a valuable skill for any trader, helping to identify potential entry points and make more informed trading decisions. By mastering these bullish candlestick patterns, traders can enhance their ability to predict market movements and capitalize on profitable opportunities. So, keep an eye out for the hammer and bullish engulfing patterns in your trading journey. Section 4. Recognizing bearish signs, shooting star and bearish engulfing patterns. Just as we have bullish patterns that signal potential upward movements, there are bearish candlestick patterns that warn of potential downward price movements. These patterns are crucial for traders and investors to recognize, as they can help in making informed decisions about buying, holding, or selling stocks. These bearish patterns are like red lights on the road, indicating a higher probability of the stock price declining. They serve as warnings that the market sentiment might be shifting from bullish to bearish. One of the most recognizable bearish patterns is the shooting star. Imagine a shooting star streaking across the sky, leaving a trail behind. This visual can help you remember the characteristics of the shooting star pattern. The shooting star pattern has a small body at the bottom and a long upper shadow. This formation occurs when the price opens, rises significantly, but then closes near the opening price. It suggests that buyers initially pushed the price up, but sellers took control, driving the price back down. This shift indicates that the upward momentum is weakening and a reversal might be on the horizon. Another powerful bearish signal is the bearish engulfing pattern, which is essentially the opposite of its bullish counterpart. This pattern features a large red candle completely engulfing a smaller green candle. The larger red candle indicates that sellers have taken over, overpowering the buyers. It indicates a powerful shift in momentum from buyers to sellers. This shift is a strong indication that the market sentiment is turning bearish and a downward trend might follow. For example, observe the chart of HDFC Bank from September 2023. This chart provides a clear illustration of how these patterns can appear in real market conditions. The shooting star pattern formed near the resistance level, followed by a bearish engulfing pattern. The resistance level is a price point where the stock has historically had difficulty moving above, making it a significant area to watch for potential reversals. These patterns hinted at a potential trend reversal, and as expected, the stock price declined. Recognizing these patterns can be a valuable tool in a trader's arsenal, helping to anticipate market movements and make more strategic decisions. By understanding and identifying these bearish patterns, traders can better manage their risk and potentially avoid significant losses. It's not just about recognizing the patterns, but also understanding the context in which they appear. Utilizing various tools and indicators in conjunction with these patterns can provide a more comprehensive view of the market. This holistic approach can enhance the accuracy of predictions and improve overall trading performance. Engaging in discussions with fellow traders and continuously educating oneself about market trends and patterns can also be beneficial. The more knowledge and experience one gains, the better equipped they are to navigate the complexities of the stock market. In conclusion, recognizing and understanding bearish patterns like the shooting star and bearish engulfing can provide critical insights into potential market reversals. These patterns are essential tools for anyone looking to make informed trading decisions and stay ahead in the ever-changing world of the stock market. Chat. Section 5. The Enigma of Doji Candlesticks. Doji candlesticks are unique and often shrouded in ambiguity. They are one of the most intriguing patterns in technical analysis, capturing the attention of traders and analysts alike. These candlesticks have a small body or no body at all, with the opening and closing prices being very close or equal. This characteristic makes them stand out on a chart, as they differ significantly from other candlestick patterns that show clear price movement. They represent a state of indecision in the market, where neither buyers nor sellers are in control. This tug-of-war between the two sides creates a balance, reflecting uncertainty about the future direction of the market. Think of a doji as a pause in the market story. It's a moment where the market takes a step back, reassessing its next move. This pause can be a critical juncture, often leading to significant price movements. It's like the market is taking a breath, unsure of its next move. This moment of hesitation can be a precursor to either a continuation of the current trend or a complete reversal, making it a crucial point for traders to watch. There are various types of doji patterns, each with its subtle implications. Understanding these nuances can provide traders with valuable insights into market sentiment and potential future movements. For instance, a long-legged doji has long upper and lower shadows, indicating significant price volatility during the period. This pattern suggests that the market experienced a wide range of prices but ultimately closed near its opening price, highlighting the indecision among traders. A gravestone doji has a long upper shadow and no lower shadow, suggesting buyers pushed the price up, but sellers pushed it back down to the opening price. This pattern often indicates that the upward momentum has been exhausted and a downward reversal may be imminent. Conversely, a dragonfly doji has a long lower shadow and no upper shadow, indicating that sellers pushed the price down, but buyers managed to bring it back up to the opening price. This pattern can signal a potential upward reversal, especially if it appears after a downtrend. While doji patterns can be confusing on their own, they gain significance when they appear after a strong trend. In such contexts, they can provide critical clues about the market's next move, helping traders make informed decisions. They often act as warning signs, suggesting a potential reversal in the trend. Recognizing these patterns and understanding their implications can be a powerful tool in a trader's arsenal, enabling them to anticipate and react to market changes more effectively. In conclusion, the enigma of doji candlesticks lies in their ability to encapsulate market indecision and potential turning points. By studying these patterns and their context within the broader market trend, traders can gain a deeper understanding of market dynamics and enhance their trading strategies. Whether you're a seasoned trader or a novice, paying attention to doji candlesticks can provide valuable insights and help you navigate the complexities of the financial markets with greater confidence.